All right, obviously a lot going on today. It's June 17th, 2022, and it was an update just like I predicted yesterday, but it's not as massive of an update as I thought. Anyway, I reduced my leverage just a tiny bit. I didn't really feel like selling out any of these positions that I thought were pretty strong, so I'm still pretty levered. However, you'll see some changes in the account, like for example, the Chinese stocks. Some of them are completely gone. Like JD is completely deleted from the account now due to options activity. And I only have some VIPS shares that will probably get deleted as well next week. But I'm going to go into the account now, and then I want to share with you the most undervalued company in existence ever. Well, I mean, okay, the most undervalued, well-known company ever. That's not an ADR. There's no catch. There's not a VIE, nothing, not like that. It's a US company, US-based company. It is an internet-based company. It's a multi-billion-dollar company, mid-cap company, and it's extremely undervalued. So I want to share that with you. I want to see how you react. So this is the account, almost at 159,000, just actually 4,000 higher than yesterday, even though Robinhood says 2,000 higher. But anyways, this is the week performance here, 3% down, and then 4.4% down on the monthly chart. 3-month chart almost down 10%. Yearly chart down 4.5, and all time is up pretty high. But whenever I do show the all-time chart, I have to say that I started investing in August 28th in 2018. So that's why the line is flat before that time period. So you just go from there. Okay, so I'm at a low point, especially for the year, but I'm hoping that things recover with these little bounces. I'm able to even the account up. Now, I'm going to go through the options positions first and then the equities. You can pause the video player at any moment to try to figure out the exact position. Any information that you might need is just in this little box here. You can pause and read so you can see what's going on. I have the only short position I have is actually this. I bought some puts on Untitled Chapter just in case there's a startup, like a down day on Monday, but I doubt it. So a lot of the leaps, actually, the Chinese leaps work today. The JD ones were up 26%, which is crazy. This one expires on January 20th, 2023. I'm actually still down 40% on this trade, so we'll see what happens. Then we got Alibaba, 3 call leaps expiring on January 19th, 2024. And 3 PayPal ones, which are not doing too hot right now, but hopefully things improve. Okay, on to the equity positions. I sold 5 shares of Apple. That was about the most deleveraging I did today. So I'm sitting at 830 shares. So if I get to 1,000 shares with Apple and it runs up to 200 a share, which I think can happen in the next year or two, that alone, the Apple position alone, will be contributing $200,000 of the account. Quick math. Super math skills. Realty income was up 1%. Main Street Capital regained some ground here, and I was unable to, unfortunately, actually, I wanted to scoop up some shares at $35, and it was under $35 for a large part of the day, but then it rallied up. I collected my premium for my put sales, 3 sales, but I did not scoop up any additional shares, so I'm going to have to content with 945 shares that I have right now. Probably yielding me a little bit over $200 per month in dividend. Okay, moving on. We got Goldman Sachs down 2%, just continuing to get killed. Goldman Sachs in new, undervalued territory. Pretty crazy. Down almost, more than $4,500 on this so far. The price to earnings is 5.53, not updated, so it's probably like 5.4 or something like that right now. Pretty pretty undervalued. Citigroup, my puts expired as well. It didn't drop below 44. I would have loved to scoop some Citigroup. But moving on, I was forced to buy some EBIX, unfortunately. So I sold some puts, sold a couple puts, and now I have 200 shares of EBIX, which is a tragedy because there was a short report by Heidenberg, I think. I forget. And it basically called it out on its BS and claimed that all the revenues in India are basically bogus. So that's why it went down like 40 or something percent. Small rebound today. So we'll see what happens on Monday. But here you can see the drop from 23.40. I would have been fine here, but then the short report came out and now it's all the way down to like, it was down to 12.77. Now it climbed back up to 16.15. We'll see what happens. But if you're wondering what basically the report said is that they think most of all of their basically revenue in India from the gift card business is a farce. EBIX claims that they have 970 merchants offering their gift cards, and apparently Heidenberg called all 970 of them. Half of them basically didn't respond, and the other half said they don't even carry the cards. Only about 30 merchants said they carry the cards. So 30 or 40, I forget, somewhere in there. So really small figure, and I think that I don't know what to make out of this report. And also they said that the two major clients of this part of their business, or some part of their business, I think the gift card business too, are basically shell companies that are inoperative, and they can't even reach anybody in charge of them. So they think that the revenue in India on the gift card side, which contributes to the vast majority of the growth of the company, is made up. It's fictitious. And so therefore the drop in price. So there could be something fishy going on. They coupled that with the fact that EBIX keeps changing auditors, right? They keep changing account firms. What are they called? Accounting firms to take care of their books. So we'll see. See what happens with that. What else was I going to say? Oh yeah, so if indeed all the revenue is legit, this is extremely undervalued, right? Especially since they're going to have the EBIX Cash IPO in India, and if it's legitimate, I think it's going to yield them at least like $1 billion or $2 billion worth of cash right away from selling all these shares, and they can completely pay off their debt, which is what they plan on doing, and have some cash left over, and the price of EBIX will skyrocket. But if it indeed is a scam, I mean, that's really bad. This thing's going to zero. They're going to get sued, and everybody is going to lose all their money if you're invested in EBIX. Moving on down. So that's an EBIX story. Proud owner of 1,400 shares of Paramount. Up $1,000 today. Still negative 5K on the position. However, dividend coming in at $288 helps to soften the blow a tiny bit. This company is making a ton of money. It's a cash machine. Price earnings under 4. It's incredible. Dividend yield 4%. Better than you can get on a bond. So, maybe not a 30-year one, but I don't know what the yield is right now. But it's pretty good. And 4 times the earnings. If they keep, what that means basically, another way of looking at it is, if they keep making the same amount of money for 4 years, your initial investment will be paid off just by, earnings. Of course, they don't pay all of them out in dividends. They might repurchase shares or they might reinvest, etc. But the point stands that in money made, in earnings, your initial investment will be paid off in 4 years. It's another way of looking at it. All right, I think that's the account, all the account positions. Let's take a look at the investing tab, sitting at $278,800 total market value. 159 is mine, 119 is, 120 is on margin. Margin percentage is just a little bit, 43%, which means 86% in real terms here. Total return, these are all the equities sorted by equity, by position. Number 1, Apple at 109, then Goldman Sachs 43, Paramount taking the number 3 spot at 35, Main Street falling down to number 4 at 33,000, Realty income 23,500. Quite a bit more diversified at the moment than it was just maybe a week ago. So that is the accounting tab. I'm sorry, the investing tab, accounting tab. A little Freudian slip there. All right. Anything else that I gotta show you here? Oh yeah. Part number 2 of this video, the most undervalued company ever. It's not a foreign company. There's no tricks, no catch. All right. This is a legitimate company. It's an internet business. It makes a ton of cash. Everybody knows the name. It's got a good brand name. It's got brand everything going for this company, and it's the cheapest company. You ready for this? Boom. Oh wait, you can't see it. Boom. That's right. It's eBay. eBay, the cheapest company. Look at this. Look at this thing. Let's take a look at these charts first on the bottom right. Revenue and earnings. Look how crazy this thing is. Doesn't even make any sense, right? Doesn't make any sense. How can you make more money than revenue? All right. Let's go deeper here. Let's go into financials to find out what the hell is going on, right? Shifting to quarterly. Look at this revenue. Steady. Unchanged. Look at this operating income. Not declining, right? Not declining. This is like having a shop and just keeps making the same amount of money each year. That's what it's at. It's not growing, but it's also not contracting. And what are they doing with the money? Look at this. Shares outstanding. You see, they were, since 2017, they're basically half of what they were at the end of 2016, beginning of 2017. Half the shares. So if you owned 1% of the company back then, 7 years ago or something, 6 years ago, if you owned 1% of the company, now you own 2% of the company. How crazy is that? Let's take a look at the dividend. 2% dividend. Do you think that weighs on the company? Not at all. Payout ratio of 4.3%. They're only using 4.3% of their earnings to pay a 2% dividend. So theoretically what that means, right, is they could, they could have a dividend that's 20 times higher than this. So theoretically they could pay out 40% dividend and still tread water. They could pay out 40% dividend. I mean, if they want to. They won't, but they could with the earnings they have in 2000, this far. I think this is year over year. It's absolutely insane. All right, let's take a look at some statistics on this company, right? If you don't believe me yet. First of all, they don't have that much debt. Look at this. Right? The enterprise value is almost 27 billion. The market cap is a little bit over 23 billion, which hints at a little over 3 billion in debt. Let's take a look. Net cash, 3.25 billion. Perfect. All right. Cash and cash equivalents, 5.57. So they have a lot of cash on hand in order to operate the business. Yeah. Check this out. Let's start with the EV. Enterprise value over earnings, 2.31. Remember how we just talked about the 4 PE, which means 4 years to pay off your initial investment and earnings? Well, what do you think a 2.3 Well, how about this? A 2.21 PE is 2.28, excuse me. I mean, it's a little over 2 years and you pay off your initial investment if the earnings are steady. But you saw the earnings, right? We looked at the graph. They're pretty steady. They're not like in huge declines or anything like that. People are expecting this to decline, but it's not reality. So that's not what's been happening. It could happen in the future, but thus far it has not been happening. EV over sales, 2.62. Look at this. Look at these earnings. Now, this looks a little fishy, what I'm about to show you. I don't even know what's going on with this. Profit margin, 113%. I don't know what's going on. But I'm assuming the rest of the figures are correct. I probably should look at their 8Ks or whatever. Or 10Qs or I don't know. Whatever the form was. So this is pretty insane. I mean, I don't understand. I understand that this company is not growing and probably never will grow. But these figures are absolutely ridiculous. Let's take a look at the balance sheet. Growing cash a little bit. Let's see, total assets increasing. 26.6 billion. Total liabilities, 16.8 billion. Current debt, I mean, it doesn't look bad at all. All right. So there you go. Most undervalued company in the entire world. In a good jurisdiction. This is, a veteran from the dot-com boom. Tech company just like Amazon or any other company out there. E-commerce, right? They have their own little niches and everything. And now they don't even have to pay PayPal fees. They're not decreasing in earnings and revenue. They're staying steady, returning capital to shareholders, paying a nice dividend. Payout ratio is lower than any other company out there for a 2% dividend. It's incredible. You gonna buy it? What do you think? Should I buy it? All right. I'm planning on doing some company review videos over the weekend. So if you have any requests, put it in the comments below. I'll do a video about it. If not, you're gonna have to listen to me talk about like Gap or some other clothing company or something like that. All right. So if you have any requests, let me know. Okay. Peace out.